Welcome to the Explainer. So, today we're tackling a scenario that is, frankly, incredibly frustrating, yet surprisingly common, especially if you're self-employed. Picture this, right? You've got a thriving business. You've got these grand, ambitious plans for expansion. You even have a property sitting on an absolute gold mine of equity. You've done the hard work, built the value, and now you're totally ready to take that next big step. But you walk into your bank to secure the capital, and they knock you back. Why? Well, simply because your paperwork doesn't fit neatly into their rigid, pre-formatted little boxes. It's a brick wall that so many successful entrepreneurs hit. But today, we're grabbing the sledgehammer you need to break right through it.
Okay, let's dive into this. When you have a solid track record, the sting of a bank rejection, it isn't just about pride. It's a massive roadblock to your momentum. I mean, what actually happens to your grand expansion plan when a traditional lender just outright says no? For a lot of folks, the initial reaction is panic or just this crushing feeling of defeat. It feels like someone literally hit the pause button on your entire year of growth. But as we're going to see today through a real-world case study, a bank saying no doesn't mean your business expansion is actually over. Honestly, it often just means you're talking to the wrong kind of lender.
See, there's this massive disconnect for so many self-employed folks out there. On one hand, you have a thriving business and high equity tied up in real estate, right? This is real, tangible wealth, real business capability. But on the other hand, traditional banking institutions, they operate on these really rigid algorithms and super strict criteria. They rely heavily on perfectly straightforward company structures and completely finalized tax returns. If your real-world success doesn't perfectly translate into their stiff operational templates, well, the system just defaults to a rejection. They simply don't have the flexibility to look at the nuance of a thriving, dynamic business. Section 1. The complexity trap. Why traditional banks panic. Let's look at a specific client who recently navigated this exact nightmare. We're talking about an entrepreneur with fantastic drive and a rock-solid 5-year trading history. They wanted to tap into their property's equity to fund a major expansion, but their application completely stalled and was hit with an automatic rejection. And this brilliantly illustrates what caused the bank system to basically short-circuit. The client operated within a web of 6 different companies. Now, to you or me as entrepreneurs, this is just smart future-proofing for liability or maybe remnants of past ventures. But to a bank's algorithm, this looks like a giant, terrifying ball of yarn. Let's break it down. 4 of these companies were entirely dormant, non-trading. One was a brand new entity trading for only 6 months. And then there was the primary entity, the actual engine of the operation, which had that solid 5-year trading history. But to a traditional bank looking for a simple, straight line of income, a 6-company structure is just a massive red flag. It's way too complex for their standard risk models to process easily. And hey, if that complex structure wasn't enough, here's the final nail in the coffin: missing financials. At the exact time of the application, the client's accountant simply hadn't prepared the financials for the previous year yet. Remember, standard banks absolutely rely on having the latest, finalized tax returns right in their hands. Without those, the bank couldn't tick their most important box. So when you combine a 6-company web with missing financials, boom, it resulted in an immediate automatic no. Section 2. The low doc pivot. Working smarter, not harder. Now, this is where the story shifts. Because the client's primary business was remarkably strong, and they had substantial equity tied up in the real estate, the problem wasn't their business at all. The problem was the lending strategy itself. They needed a lender who actually specialized in complex self-employed setups. Enter what the industry calls alternative documentation, or the low doc approach. Instead of waiting around for months for your accountant to finalize traditional paperwork just to appease a traditional bank, this strategy totally changes the rules of the game. It allows entrepreneurs to secure loans and access the real estate equity without relying on those traditional finalized tax returns. It's a completely different pathway to the exact same goal. Section 3. Unlocking $500,000, bypassing the red tape. By pivoting to this strategy, the usual hurdles just vanish. We are talking about completely sidestepping the rigid rules that triggered that automatic rejection in the first place. I mean, just think about this for a second. 0 bank statements required, 0 business activity statements required, and, most importantly for our client, 0 finalized tax returns required. Literally all the documentation that the traditional bank demanded, the exact paperwork the client was waiting on, was completely removed from the equation. This absolutely eliminates that frustrating roadblock of missing financials. So the crucial point is, if you aren't using mountains of standard paperwork, what on earth are you using? Well, you're using the power of the accountant's letter. This is the magic bullet of the low doc strategy.
Instead of providing years of complex tax returns across 6 different companies, the lender just accepts a single, verified letter directly from the client's accountant. That's it. This one letter formally confirms the client's income and their financial ability to service the new loan. It basically distills all that structural complexity down into one clear, authoritative document that a specialized lender can confidently act upon.
And here is the absolutely spectacular result of that single letter: $500,000. By utilizing this specialized lending strategy, the client was able to completely transform their financial position, totally wiping out that initial sting of rejection. Not only did they successfully refinance all of their existing business loans to streamline their debts into one manageable place, but they also unlocked a massive $500,000 in cash. Yeah, you heard that right. $500,000 pulled straight from their property's equity, ready to inject directly into their grand expansion plans. Talk about a game changer.
Section 4. Making your equity work. Scaling as planned. So what seemed like a complete disaster, a stalled application, and a totally paused year of growth was instantly transformed. By making their equity work for them through the right channels, they didn't have to wait. They didn't have to scale back their ambitions. They are now scaling their business exactly as they originally planned, all because they bypassed the traditional bank's red tape. Which brings us to our final thought for this explainer. I really want you to ask yourself, could your equity be working harder for you? If you're self-employed, if you have equity sitting there in any real property, and you just know that capital could be better allocated to grow your wealth or expand your business, please don't let a traditional bank's no be the final word. The standard boxes are not the only way to play the game. There are specialized strategies designed specifically to find the yes when the banks say no. Thank you so much for joining me for this explainer, and I highly encourage you to take a hard look at your own equity today and ask yourself how hard it is truly working for your future.